Welcome to the Jay Martin Show, where we dissect the greatest minds in geopolitics and finance. My guest today is not only a world-renowned economist, but he is an expert in currency reform and hyperinflation, two topics that we discuss today. His name is Professor Steve Hanke. Always a pleasure to have the professor on the show. I know you're going to enjoy this episode. Here it is.
This is Jay Martin.
Here I am with Professor Steve Hanke. Steve, it's great to have you back in the program. Thank you for making the time.
Great to be back with you, Jay.
Here's where I want to start. What's your take right now on major economic events that the public or the media are misunderstanding, Steve? What is important that most people are misunderstanding right now in the broad economy?
Well, in the broad economy, I think most people are just missing the fact that the money supply is the fuel of the economy, and you got to keep your eye on the money supply and movements in the money supply, because once there's a movement in the money supply, then there's a lag of between 1, sometimes up to 3 years before it hits the fan, so to speak, and the course of the economy changes directions or changes speed, shall we say. It can change directions too. I think right now, for example, let's look 2020 to 2024. So that period, that COVID, post-COVID period, what happened in most places accelerated the money supply tremendously, and that bled into first changes in asset prices went up, then the economies boomed, and then the last thing you had, inflation came into the picture. So that was on the upside, and just so we have this one right, looking at the money supply and using the quantity theory of money, John Greenwood and I predicted that on that upside in the United States, inflation would peak out at 9% per year. Well, it peaked out at 9.1%, so not bad. Now, they slammed on the brakes, put things in reverse, and the money supply is actually contracting in the United States and many other countries. It's slowing way down. And what's happening? We're seeing, again, with a lag, inflation starts coming down. Now, in the United States, to give you an idea of how severe the contraction is in the money supply, the stock of money in the United States, broadly measured by M2, is actually less than it was in July of 2022. And that kind of contraction, we've only witnessed that 4 times in the United States since the Fed, the central bank, has been in place since 1913. And all 4 of those other occasions were followed again with a lag after the money supply contracts. The economy starts slowing down, inflation starts coming down, and in fact, all 4 of those cases, they really slowed down. One of them was 1929, 1933. That was one episode of a huge contraction. You know what happened then? We had the Great Depression. The others, in the late 40s, there was one. There was another one in the late 30s and another one in the 20s. All those had recessions associated with them. So that's why Greenwood and I think the U.S. will continue to slow down and probably slip into recession late this year or early next year. And that's why we also think, I told you, we hit the bullseye with the inflation forecast on the upside. and the downside, we have been forecasting that it's going to end the year at 2.5 to 3% per year. It's at 2.9 right now, so it's clear we're right on again. So the lesson here is most people don't pay attention to the money supply, and when I say most people, that includes the Federal Reserve. They have discarded the quantity theory of money and the notion that the money supply is somehow changes in the money supply are connected with changes in the economy, the real growth in the economy, and inflation. In short, nominal GDP. Remember, nominal GDP is just inflation plus real growth in the economy. And that is what gets moved around by movements in the money supply, again, with these long and variable lags. So that's a big thing that they're missing. They're also, I think, missing some two huge disruptive potential factors, and that is we got two big wars going on that the United States is very deeply involved in funding and active in, and one is in the Middle East and Gaza, and the other is in Ukraine.
Okay, so pulling on both of those threads then, when it comes to money supply, in hindsight, I think everybody can recognize as we increase the money supply from 2020 forward, that's why we saw asset price inflation. We saw general inflation hit 9%, and we saw, in theory, an economic boom. So you could extrapolate and say, when the reverse policy is implemented, you should see the reverse impacts, right? And you're forecasting inflation to hit somewhere around 2.2, 2.3%, us to enter an economic recession properly. And then I would assume asset price deflation as well. Is that correct?
Yes, I think the PE ratios in the stock market are very, very elevated any way you want to look at it, and they'll come down because the top line revenue to companies will come down, and cost won't come down. So by definition, the margins will get squeezed and earnings will get squeezed. And if you look at some of the forward guidance of companies, they're already cranking in this downward kind of squeeze, shall we say? But I don't think they're factoring it enough. But one thing you said, Jay, you say in retrospect, most people think that the increase in the money supply had something to do with inflation. Well, I think maybe a lot of ordinary people might think that, but you don't find that in the press at all. And just look at the presidential campaign. We've got a presidential candidate, Vice President Harris. She's talking about greed, and the cost of living has gone up because grocery prices have gone up 20% since start of COVID. Well, yeah, everything's gone up. I mean, the price index itself, the whole thing has gone up by about 20%. And the reason for that is because the money supply exploded for a while. Mm-hmm. So that's literally in the press constantly. So when I were talking about greedflation, and before that we were talking about, remember those supply chain shocks. Everybody said, well, we had the glitches in the supply chain, and that caused inflation.
Right.
And we had oil prices going up, and that caused inflation. Well, now all of that, those things are all symptoms. The causes of everything going up is the fact that the money supply skyrocketed. And in the United States, the money supply that's consistent, the growth in the money supply consistent with the Fed hitting its 2% inflation target, is about 6%. That's what I call Hanke's golden growth rate. Mm-hmm. So using the quantity theory of money, making all the calculations, 6%, if you were growing the money supply at a sustained basis of about 6%, you'd have inflation of about 2%, pretty close to the target. At the peak, in February of 2021, the money supply was growing at an unprecedented rate in the United States, 27% per year.
Yeah.
So you don't read this ever in the press. If you ever read anything about inflation and what's happening to the consumer price index, you will never see any mention of the money supply.
No, you never do. And you still don't today. Coverage coming out of the DNC and a lot of Harris's policies towards grocers specifically. You just mentioned that, and her ambition to fix price gouging on the behalf at the behest of grocers. Okay, is very misleading and quite frankly quite gaslighting. So I want to stick with money supply for a minute, and then I want to get to your other two big wars, the other major event that people are misinterpreting or misunderstanding. But is there a case to be made, Professor Hanke, where you could say, as rates go up, the theory is we increase rates to make debt less attractive, slow down borrowing and credit, cool the economy, cool inflation. All of this is true. But there are certain parties, like maybe cashed up tech companies, that have locked in long-term debt at favorable rates back in 2021. And so as rates increase, their debt obligations don't increase, but they hold their treasury in cash and cash equivalents, and those cash equivalents are impacted by rate increases. They're actually getting paid more on their cash and money market funds. And so in a rising rate environment, their incomes go up and their costs stay fixed. And this is actually positive for them and almost like stimulatory. Can you see that angle, Professor Hanke?
Well, when you look, number one, it's very important to keep in mind that monetary policy is not about interest rates; it's about changes in the money supply. So that's the first point. The second point I'd make is that changes in interest rates affect different sectors of the economy in different ways. So the scenario you just gave is a realistic scenario for some companies. If that's the way they've got their capital structured and their operating income flows are based as you described them, obviously they're going to be smelling the roses as interest rates go up. They benefit. So yes, interest rates do have different effects on different parts of the economy.
Okay, now you mentioned PE ratios are getting quite elevated in probably the broad equity market. I could imagine one sector where earnings are increasing very favorably is the gold sector, and the equity prices don't reflect this at all. But if you look at the Newmonts and the Barricks, Anglo Ashanti is the exception. They're kind of flat year over year. But earnings for a lot of these gold producers do reflect the rising gold prices, but the share prices don't reflect that at all. Do you watch that investor sentiment much, and do you have any thoughts on that?
Well, I just watch the bullion market itself, and as you probably recall, I think once when we were speaking of gold, I've been a bull on gold for quite some time now, and by the way, gold usually does quite well going into a recession. Yeah. You're talking about a recession coming and in the winds, and usually gold does well going into a recession. So I'm not surprised that it made new highs in the last few days, and it's trading on the strong side.
Yeah, you mentioned that the last time you spoke. Okay, so pivoting to the second event that people are misinterpreting, you referenced the two big wars, one in Gaza, one in the Ukraine. What is the impact that people are missing here, Professor?
Well, in general, again, different sectors behave in a different way, but in general, war is bad for the economy. It's not good. Peace is good for the economy. Peace and stability are good. Wars are bad. Among other things, they throw a lot of uncertainty into the picture, and affect things. Just look at the effect the Houthis have had in the Red Sea and the Suez Canal and shipping rates, container shipping rates and oil transport, anything anything by sea, a lot of it goes through the Red Sea and Suez, and that's been to a large extent diverted because of the war. So there you have a sector, an important one, and their costs that are associated with that interference that's going on. Now that does get priced in pretty specifically to insurance rates and shipping costs, but there are more general aspects of a war, particularly a war that's escalating, and it looks to me like we have escalation in the Middle East, or potential escalation, and we have roughly the same thing going on in the Ukraine. So, and I don't see that priced into the market in general at all, because if you look, for example, if you look at the U.S. market, just to give you some idea of what's going on, Professor Schiller at Yale has a model, CAPE, cyclically adjusted PE ratios, and that adjusts PEs for inflation. So you're looking at it in inflation adjusted terms. That ratio right now is 35 times higher than the average in the past decade, and it's the third most expensive that we've ever seen since the 19th century. So it's very high. And now some people don't like that, and they like to look at forward PE ratios. Those are very expensive too. And then we've got something called the Fed model. That's another way to look at the market that compares bond yields and stock yields. Stock yields are pretty low now relative to bond yields, and that simply means, again, the prices in the market are pretty high. And then you look at operators like Warren Buffett, and what's Buffett been doing in the last couple of quarters? He's been cutting way down on his holdings of securities and piling up cash or cash equivalents, and he actually, Berkshire now actually holds more treasury bills than the Fed does. So he's got a mountain of cash that he's accumulated, and I think that's because he thinks everything's very pricey, and he also spots what I spot, and that is some storm clouds on the horizon and a storm moving in, and a slowdown coming, and maybe a recession coming. So that's kind of the shall we say the unanticipated things, the kind of mispricing in the market in general is that statement is backed up by the fact that you get these very high forward PEs. The Fed model also signaling very, very expensive market, and Professor Schiller's CAPE, cyclically adjusted PE ratios at almost all-time highs. So there's not much to buy in the market now. There's not much, no real good deals out there. So okay, you can hold on to your good stocks and ride them, but you better keep your eyes wide open about what those storm clouds might have in them.
Yeah, Berkshire Hathaway's cash position is bonkers right now. You're 300 trillion or something like this. Is that your general? Would that be your general counsel right now, Professor Hanke, to investors? Would be that it's a time to maybe sit back on the lifeboat a little bit, sit in cash, and be patient and wait. There's too much complexity, too much uncertainty to have any true high conviction ideas.
Yes. And by the way, by sitting back, one trade I mentioned, gold is something I like, and it's going up. The other thing is that with the contraction in the money supply, the inflation comes down. And I told you what Greenwood and I thought the inflation would end the year at, 2.5 to 3. It's at 2.9 right now, and it'll keep coming down. Now, yields on bonds follow inflation rates. So if the money supply is contracting, and we think that the inflation will continue to go down, what's that mean? That means that bond yields will go down, and if bond yields go down, the price of the bond goes up. Or to put it another way, the price of the bond goes up and the yields go down.
Mm-hmm.
But if you look at the 10-year bond right now, I still think that's a great trade in the U.S. Not much risk. You're getting paid good money, and you'll probably also pocket a nice little capital gain because the yields will continue to go down. When I started recommending the 10-year, the yield was about 4.8. Now we're down below 4.
Mm.
So you've had a big capital gain, and you've been getting paid, a good interest rate. So those would be things that the posture I would take, as you said, is kind of laying back, selectively lightening up. Do what Buffett has been doing.
Could you expand that counsel, I suppose, to small business owners? If you were talking to a room full of small to medium business owners, variety of industries, some are in services, products, industrials, tech, all over the map, and they were looking for guidance on how to build their strategy going forward over the next just 1 year, right? Is it a time to batten down the hatches and be very conservative? Is it a time to hold on to your best?
I think, again, it depends on the sector you're in.
Okay.
But in general, just as a general thing, if you think a recession is coming, you want to keep your powder dry.
Yeah.
You don't want to get overexcited. And you might have a great business strategy, but maybe the time to execute it would be to wait a little while and not jump in ahead of the storm. Why get caught in the middle of a storm?
Yeah, totally. So with that caveat, it depends on what sector you're in. Do any stand out to you as more favorable or more vulnerable at this moment? Any industries you're more excited about or more concerned about?
Not really.
Okay.
I don't have any good advice to give there because I'm not looking. I'm looking at the market in general.
Yeah. Okay. All right.
And for example, I'm thinking more in terms of like the Fed model, where the Fed model is comparing bond yields and yields, dividend yields and stocks, that kind of thing. What's the market look like now? The market looks very toppy to me.
Mm-hmm. Okay. Now, I know you have a book coming out in September. Can we talk about that today?
Yeah, we can talk about that.
Okay, so you have 3 books coming out actually, but the first is coming out in September. So walk me through the thesis, Professor.
Well, the September one I did with Leland Yeager, the late Leland Yeager. Yeager would have been 100 years old this year, so I'm delighted that the book we were working on for many years is going to come out on his centennial year. I just regret that he didn't make it to the finish line himself so he could celebrate. But at any rate, the thesis of the book that'll be published by Palgrave Macmillan is that if you look at the economy, the standard models, all the models for many, many years have been the 3 basic inputs are land, labor, and capital. You put land, labor, and capital in, you get more of it, and you get more out on the other end. So this book is on capital theory. It's called Capital, Interest, and Weighting. And the weighting part is that we have developed an idea and I think it's sound in capital theory, that waiting is a fourth factor of production. That is, not consuming today, waiting, saving today, and consuming at some point in the future. And that input, land gets paid rent, labor gets paid wages, capital gets paid interest, and waiting gets paid interest. So that's the nub of it. It's a book. As I like to think, it will make some waves among the high priests of economic theory, because it's kind of the overarching model for economics. I mean, the key question is, well, if you change inputs, well, what happens to the output in an economy? And what we're saying is that, well, there really aren't three inputs. There are actually four, waiting being the fourth, and the payment for waiting. Why do you wait? Why do you not consume today? Because you get paid an interest. If you weren't getting paid interest, you wouldn't have much of an incentive to wait around.
Now, I can easily, and anybody could understand, land gets paid rent, labor gets paid wages, capital gets paid interest, and I could maybe speculate and guess a little bit, but could you expand on the concept of waiting being paid interest?
Well, if again, if you decide not to consume everything that you're earning today, and you get paid no interest on it, and in fact, you will, in most economies, you'll be actually have an inflation tax imposed on you.
Yeah.
You're not going to be too keen on waiting to consume.
Correct.
You consume today. You'll spend everything today. Now, if you're getting paid interest, the story starts changing around, because if you're paid an interest on waiting to consume, you give a second thought. Maybe you decide maybe it's a good idea to put some under the mattress, so to speak, because it's going to grow. I'll have more to spend tomorrow and consume than I will today, because why? I'm getting paid interest on it, or I'm getting a yield on it, depending on what you do with the waiting.
So in that sense, is the waiting something that could be applied to capital? Because the longer you wait to deploy capital, the longer you can sit back and collect interest on it. The longer you sit on land, the longer the land might elevates in price. What's the mechanism and the activity that is waiting that generates the interest?
Well, you have to do something with your what you're waiting and not spending. So there's a question of, well, what do you do with the funds that are accumulated while you're waiting? And then the decision to wait. Are you going to wait a long time for example, are you going to cut the tree today, or are you going to wait until next year?
Yeah.
Well, that depends on how much the tree's growing, and what the price is going to be for the timber the logs that you're harvesting off the land. So that's why the book is called Capital, Interest, and Waiting. So it is part of capital theory. I mean, formally in economics, it's part of capital theory. So that's what we've delved into. So we get into there are lots of puzzles in capital theory, lots of problems in capital theory. We think we've solved those or clarified them. And at the end of the day, the big thing that I've given you is this idea of waiting. And that is a factor of production, like land, labor, and capital.
Mm-hmm.
And if it's a factor of production, well, what's the factor get paid by? Well, it gets paid by a return and interest rate.
Mm-hmm. Interesting. Okay. It reminds me of this test that is applied to children in order to determine their probability of success later in life, where they're given the option to consume something small today. It's called the marshmallow test, actually, in an obscure way. They're offered one marshmallow today or two marshmallows tomorrow, or some equivalent of this. And it's to test the child's acumen when it comes to waiting for a larger reward versus consuming a smaller reward today.
Right, and that's a great little test, and the essence of waiting is embedded in the marshmallow test.
Yeah, right. Yes. All right. Your next two books, because they're right behind, actually, coming out. You've got Capital Interest in Waiting coming out in September. Two more books in the pipeline that I believe are done or close to done. Walk me through, if you wouldn't mind, the ideas behind each.
Well, the second one is a book I'm doing with Matt Sakurki, who's a former student of mine and quite an accomplished economist, and at this point with multiple master's degrees and a doctorate degree and a long experience in finance and economics. And that book is called Making Money Work, and it's a book on money and banking. What we're talking about now, the quantity theory of money, is very much part of the book. But what we've done, or what we're doing in that book, is, I think, pushing monetary theory to kind of a new level. And the general thesis is what should be done to make money and banking work better than it works right now. That's the as you would say, the thesis.
Okay.
And that means better monetary policy, better fiscal policy, better bank regulation. So central bank policy, fiscal policy, and bank regulation, those three things actually are really monetary policy. If in kind of a holistic way, we're looking at those three things, whereas most people just focus on the central bank.
Mm-hmm.
and limit the discussion to the central bank. We're looking at it in terms of the total interaction between banks and banks. By the way, banks produce most of the money. About 80 to 90% of money that's created, broadly speaking, like M2 or M3, these measures that we see for the money supply. Most of that, about 80 to 90%, is actually produced by commercial banks.
Right, right.
When a commercial bank makes you a loan, what happens? They top up your checking account, and the checking account, that amount is counted in the money supply, M2. The only thing the Fed literally is producing itself are notes and coins, currency, which in most cases, is 10, 15%, something like that. So bank regulation is definitely part of monetary policy, and we're examining that in some detail. Central bank policy itself, we're looking at, and fiscal policy, and how that interacts with banks and the central bank to produce ultimately money, the money supply. What is causing the money supply to change? If you think the fuel for the economy is the money supply, and that's what makes the world go around, the question is, well, what causes the money supply to change? And that's really what we're looking at, and we're suggesting policy changes that will make that work better than it works at present, and why? Because that will increase the efficiency of the economy and the growth in the economy and ultimately prosperity.
Now, so your first book coming out in September, your next book coming out in September, Capital, Interest, and Waiting. As you mentioned, it's maybe written for the high priests of economic policy, and as I understood it, makes a case for temperance. I mean, that's essentially it. Moderation or self-restraint.
It doesn't really make the case for temperance. It shows how that works in the economic system.
Okay. Maybe. Okay.
I mean, it's really how the economy works and how waiting gets into the picture as a factor of production. Again, land, labor, and capital. Everybody who's had principles economics knows that's the paradigm.
Yeah.
Now it's going to be land, labor, capital, and waiting. And we explain how waiting fits into the picture as a factor of production and what incentivizes it. How does it get paid? Well, it gets paid by interest. So that's that one. And then the thing Matt Sekurki and I are working on, which Wiley will publish, is making money work. And as I said, that's really a money and banking book. And then the third one I've been working on with Kurt Schuler for many years, a colleague of mine. We've written a number of books on currency boards and currency reform based on currency boards, and that's a treatise that will cover completely the history of currency boards. The first one was founded in 1849 in Mauritius, and a currency board is a monetary institution that issues a currency. That currency that's issued is backed 100% with an anchor currency, another currency, and it trades at a fixed exchange rate with that anchor currency. So it's like Hong Kong, for example, has a currency board, which John Greenwood was the architect of and was installed in 1983 after they had a huge currency crisis. The Hong Kong dollar depreciated by 27% on Black Saturday in 1983. Well, the currency board was put in. The Hong Kong dollar is issued now. It's backed 100% with U.S. dollar reserves, and it trades at 7.8 Hong Kong dollars for one U.S. dollar. So what this means, these currency boards issue currencies that are really a clone of their anchors. They're the same thing as the anchor. If you don't like a Hong Kong dollar, you take 7.8 Hong Kong in and you get one U.S. in exchange.
Right.
And you know you're going to get it because the currency board has 100% reserves backing the issuance of the Hong Kong dollars that they're issuing. So these systems, there are 14 of them that exist now. There have been over 70 historically. And what Schuler and I have done, we've taken the financial records for all the 70-plus currency boards that have ever existed, and we've digitized those. We've analyzed exactly how each one of these things has been working and why they worked, and that's basically the nub of the book. How in practice all these currency boards have actually worked will be in this volume. And of course, we're advocates of the currency board. Most central banks in developing countries should be replaced by currency boards. And the reason why is that most central banks, and especially in emerging market countries, don't perform very well. They don't hit their inflation targets. They're plagued with high inflation, exchange rate volatility, production of junk currencies, basically, and they'd be much better off if they were replaced with currency boards. So that rounds out the book picture.
Okay, you got it. Look, Professor Hanke, I want to thank you for coming on the show today and chatting with me and getting back in front of my audience. I appreciate it very much.
Well, I appreciate the invitation, Jay. Great to be with you. And when the books hit the street, we'll have to get into them in more detail.
I'd love to. Capital Interest in Waiting is the first coming out, so I'll look forward to that one. Once again, Professor, thank you so much. Look forward to doing it again.
Okay, thank you, Jay.
All right.